Ironically, actually, the price change that we announced came right after the close of the quarter, and so it was a nice quarter that we were actually just adding up, and then we proceeded to take a fairly significant cut in our revenues going forward. So the story was all about going forward as opposed to the last quarter.
The price war, is it something that does annoy you a lot? I guess more of your revenues come from this sort of commission charging, around 25%, than for some of your rivals for whom it was an easier sort of headline price cut to offer up to their customers.
Yeah, this has been hanging over the industry for many years. I mean, I've been here for 4 years, and it's been a discussion point that we've talked about forever. In fact, ironically, if you think about it, right back to 1975 when May Day happened, this has been the price competition in our industry that has been coming, and it's a day that is finally here, and consumers and retail investors are better off as a result of it.
I mean, already you saw a big rush to have new accounts. You said 49% increase in the 2 weeks post-announcement. So how do you capitalize on that and offset what you expect to see in terms of earnings decline?
Well, the way we think of it is we've been preparing for this day for quite some time, and we've been investing in making sure the client experience is as good as it can be. It's probably happened earlier than we thought in terms of the competitive environment, but as you know, TD Ameritrade used to compete at a slightly different price point, a little higher, because we thought there was more value there, and we were gaining share, and we were the leading trading share, even with that higher price point. If you now move that to zero, we think our growth rate will be, albeit off a lower base, be even faster than it was previously. So
you're charging 65 cents a contract on options. Do you think that that's the next field to have some competitive pressure to zero?
I think pressure is on all margin products of all sort. If you think about it, not just in the wealth management space, in asset management, move to passive, over active. I don't believe that there will be any other sort of proverbial second shoe to drop. What happens often is when margins get a little thick, as they have been in our industry, we were operating around 50% margins. Now after the cut, we're moving into operating around 40% margins.
We've been focusing on the pain in your stock price and your listed competitors' stock prices for obvious reasons. They're bigger and they are listed. We can look at the share prices. But do you think this affects most of all the Robin Hoods of this world?
I think there's a few levels of competition here. First of all, for the last 40 years, the online broker, discount broker space have been gaining share from the traditional wirehouses. So that'll continue and in fact accelerate. Then there have been the new entrants like the Robin Hoods of the world that had a price point of zero as being their major competitive plank. That's now differentiated, and it's now all a level playing field. And our strategy has been, in a world that maybe eventually is going to zero, that day being here, it's better to be able to win on the client experience, and in that game we win.
I want to ask you a final question just on broader markets. We're sitting here, the VIX is below 15. Are you surprised to see such low volatility when there are so many headline risks out there at the moment?
Yeah, we were just talking about that the other day. It seems like the VIX per unit of headline, to use your measure, is quite low, other than on one topic, and that's trade. When there is a trade win that might look like it's either a deal or not a deal, that seems to move markets disproportionately to the lack of volatility on other news.